You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the deep dive. Our mission today, cut right through all the noise. We've got a big stack of source material here, global markets, geopolitical flashpoints. We really need to pull out the core forces shaping trade, currencies, and, well, risk assets right now. It feels less like a smooth ride and more like a messy convergence of surprises.
That's a really good way to put it. I mean, the global picture today is just defined by stuff few people saw coming even a month back.
Yeah.
Genuinely shocking central bank moves.
Yeah?
Yeah. New Zealand, we're definitely looking at U plus, record highs in commodities like gold. And at the same time, trade friction flaring up again, especially U.S.-Europe.
Yeah.
It's all feeding into this really sensitive risk backdrop for basically anyone in global markets.
And the big headlines, the drama, for you, the listener, really boils down to two huge figures right now. First, the U.S. dollar just keeps going, driving almost everything else. And second, gold. It hasn't just ticked up, it's smashed through a level most people thought was, well, unthinkable.
Yeah, we're not just talking a new high. Spot gold actually broke the symbolic, the psychological, the massive $4,000 per ounce level. That's huge. A number like that doesn't just pop up because of, mild inflation worries. It signals something much, much deeper about global anxiety, fiscal worries. And it's happening while the dollar is strong. That's a historical paradox we absolutely have to unpack.
Okay, right. Let's start there then. The immediate chaos. The currency carousel. Despite all the political noise in Washington, we'll get to that, the U.S. dollar is still firmly in charge. So why? Why is the greenback so relentless right now? Is it really U.S. strength, or is it just weakness everywhere else?
It's overwhelmingly a story of relative weakness and, frankly, surprise dovishness elsewhere. The dollar's kind of the cleanest shirt in a dirty laundry basket, Look at the yen first. USD JPY is pushing the upper end of its recent range.
The driver?
Japan's latest wage data. It actually undershot what the market expected.
Okay, and why is that specifically important?
Well, because it reinforces the view that the Bank of Japan, the BOJ, they're going to prioritize stability. They'll watch for messy currency moves, sure, but they're unlikely to actually tighten policy. So that keeps the interest rate gap wide, right? And that's dollar positive. Simple as that sometimes.
Okay. The yen is maybe a bit predictable on that front. But the real shocker, the move that really reset expectations, came from the Pacific, didn't it? The RBNZ.
Oh, absolutely. The Reserve Bank of New Zealand, RBNZ, just completely bucked the global tightening trend, surprised everyone. Really dovish. And they didn't just tinker. They delivered a big 50 basis point cut, took their main rate down to 2.50%. That was a profound shock.
Wow, 50 points.
Yeah. And the signal they sent was crystal clear. They see prolonged spare capacity and serious downside risks to activity and inflation. This wasn't just like hedging their bets. This was a G10 central bank basically saying global demand risks are so bad we need to cut rates aggressively now, racing for the bottom almost.
A 50 basis point shock cut. That slams the NZD, the Kiwi, right to the bottom of the G10 pile instantly. And that kind of big monetary surprise just pours fuel on the dollar's fire globally. But it's not just that shock, is it? Europe's also kind of helping the dollar by, well, not getting its act together. The euro's looking heavy. EUR/AG is just clinging to that 1.16 level. Feels vulnerable.
Yeah, the euro's issues are a messy mix, political and economic. Politically, you still got the uncertainty in France. Markets hate that kind of instability, right? Everyone in Paris is waiting for some clear path on the budget. That's adding a big political risk premium for the Eurozone's number 2 economy. And at the same time, the engine, Germany, just saw its industrial orders disappoint again. So you've got this double whammy, political worries, weak hard data. That keeps the pressure on the euro.
Which brings us back to the U.S. political scene, which is, well, fascinating because it seems like it should matter more, but doesn't. We've got an ongoing U.S. government shutdown. The White House is openly warning about job cuts. Yet somehow, that domestic chaos hasn't derailed the dollar's momentum. Why is global weakness overriding what looks like a major U.S. problem?
Yeah, that's the key insight, I think, for the listener. Right now, the dollar is acting as the ultimate safe haven, relative to what's seen as systemic problems elsewhere. The market seems to view the U.S. shutdown as, well, temporary political theater. Disruptive, yes, but ultimately fixable, even within Washington's usual dysfunction.
Okay.
But a 50 basis point surprise cut from the RBNZ, or Germany's industry consistently failing. The market sees that as signaling something deeper, maybe a structural global slowdown.
Yeah.
So faced with short-term political mess versus potentially long-term economic rot, the dollar wins that comparison for now at least.
Yeah.
Right. That strong dollar, driven by global fear, leads us perfectly to the next big story, the safe haven surge. And this is where it gets really interesting, especially with gold. Spot gold punched through that historic $4,000 per ounce level. You mentioned the paradox earlier. Gold is priced in dollars. Strong dollar usually makes gold expensive, acts as a headwind. So why did it break records now? Why defy that?
It's a classic flight to insurance assets, definitely. But it feels amplified this time by a really profound distrust, maybe, in government solvency and even monetary policy itself. You're totally right. Normally, strong dollar, weaker gold. The reason it's not happening now is because the factors pushing gold up have just sort of overwhelmed those normal currency dynamics. The support is this potent, volatile mix. You've got widespread fiscal worries in major economies, including the U.S., pervasive geopolitical risk, obviously, and just a persistent, really high bid for assets that sit outside the control of any single central bank. Insurance, basically.
So it's not just gold as an inflation hedge. It's gold as a hedge against what? Institutional failure.
Exactly that. Gold's benefiting from a kind of breakdown in financial orthodoxy. When governments are piling up debt like never before and central banks are signaling deep fear like the RBNZ did, gold becomes the ultimate hedge against a loss of faith in fiat currency, in the whole system. That $4,000 number, that's the market screaming, we are deeply anxious about long-term solvency and political stability globally, and will pay an unprecedented premium for something perceived as safe.
Okay. Shifting gears slightly to energy. Oil is also seeing a rebound, maybe more measured, but still extended. What are the main things keeping crude prices up, especially with those global slowdown fears floating around?
Well, there are really two main drivers right now. First is just anticipation, demand anticipation. Traders expect China's onshore demand to come roaring back as their markets reopen after the big holiday break.
Right, the Golden Week effect.
Exactly. That's a potentially large, immediate chunk of consumption coming back online. That's number one. Number two is the supply side remains pretty tightly controlled.
How tight?
The key signal came from OPEC plus FAM. They basically assured markets they did not talk about any quota increases beyond that modest, already scheduled 137,000 barrels per day for November. It's not a big expansion at all. It reinforces their commitment to keeping supply disciplined. And that guidance puts a sort of reliable floor under the price, balancing out some of the growth worries.
Got it. And we did see those mixed private inventory numbers crude built, but products drew down, keeping oil in a bit of a range ahead of the official data. And base metals, like copper, quieter.
Yeah, copper's consolidating. It had that surge last week, right? Now, participants are kind of pausing, waiting to gauge how activity really normalizes after the holidays, particularly in China. It needs confirmation from actual industrial activity data to sustain its move. It's like a pause before the next leg could be up or down.
Okay, so that dollar-gold paradox, the managed energy market, both driven by this deep uncertainty, which brings us neatly to the next pressure point. Because while all this monetary stuff is happening, trade policy and tech controls are suddenly right back in the spotlight. We're seeing a real shift in tone, aren't we, on the U.S.-EU front?
Absolutely. The U.S.-EU trade friction has sharpened quite dramatically. And the language being used is really telling. Reports suggest Brussels sees the new U.S. demands as actively hollowing out the understanding they thought they had.
Hollowing out, that's strong language.
It is. It implies the EU thinks the U.S. is backtracking on prior agreements, maybe trying to force the EU to adopt stricter U.S. standards on things.
And Washington's framing, completely different, naturally. They're saying their latest offer is reciprocal, fair, and balanced. That gap in perception itself signals a real risk of things escalating, doesn't it? More than we've seen recently.
It absolutely does. This shift matters because it throws uncertainty into three key areas. Actual tariff risk, standard setting, like who gets to write the rules for global tech and products and just the basic structure of supply chains across the Atlantic. If this standoff doesn't get resolved, it moves from just diplomatic talk to actual economic costs.
Okay, so which sectors specifically should you, the listener, be watching? Where's the most vulnerability to this friction?
Keep a sharp eye on steel, aluminum, definitely energy equipment, and crucially, advanced technology. Remember, this friction is happening while the U.S. is also tightening its scrutiny on strategic exports and trying to get allies to align their controls on key tech sectors, too. So the world's getting more integrated on risk, maybe, but the rules on how and where you trade are getting much stricter, more fragmented. That's a big challenge for global business.
That strategic competition kind of sets the stage for our final section, where we link all these policy and currency moves back to the big geopolitical flashpoints. Starting in the Middle East, there's an update on the Gaza negotiations.
And the regional reports are relaying some encouraging details, actually. Talks happening in Egypt are being described as very positive. Apparently, they're actively working through the remaining issues. And there's talk of an actual exchange of hostage lists being discussed. So that indicates some genuine momentum towards de-escalation, which markets always like to see.
Okay, very positive. Sounds good. But the core demands from each side still seem pretty far apart, right?
That's the persistent tension, yes. Hamas is reported as saying any deal must end the war completely and address wider Palestinian demands. That's a maximalist stance. Meanwhile, Israeli sources are emphasizing sticking to the current U.S.-backed framework, which tends to focus more on phase releases, humanitarian pauses, not necessarily a full stop to the conflict.
Yeah.
Bridging that fundamental gap remains the huge challenge.
Right. And shifting across the globe, we saw a significant hardening from Russia on the strategic front. Moscow signaled it's ditching a key Cold War-era agreement. What was that about, and why does it matter now?
Yes. Russia's foreign ministry signaled that sticking to its obligations under the plutonium agreement with the U.S. is no longer acceptable. This is the Plutonium Management and Disposition Agreement, the PMDA. It was set up after the Cold War specifically to dispose of weapons-grade plutonium from dismantled warheads, a really foundational step in reducing nuclear risk.
Okay, so walking away from that.
By abandoning it, Moscow is signaling a pretty profound breakdown in those basic shared mechanisms that were designed to manage nuclear uncertainty. It chips away at that strategic stability framework.
So this isn't just diplomatic posturing, it's eroding a real stabilizing pillar. How does that connect back to our market discussion, the dollar, the gold?
It connects directly back to that $4,000 gold price. These high-level geopolitical headlines, they keep the whole risk backdrop incredibly sensitive. When you see strategic foundations like this eroding, attention just funnels straight towards safe havens, drives gold, keeps everyone watching energy supply routes nervously, especially with OPEC Plus already keeping things tight. The risk premium goes up because predictable, high-level risk management seems to be failing.
Okay. So let's try and put all these puzzle pieces together for the listener. What's the overall picture? We've got this convergence, right? Unexpected monetary moves like the RBNZ cut, persistent political pressures in France, the U.S., major systemic risk shifts with Gaza, Russia. It's fueling volatility, driving a strong dollar based on global weakness, and pushing gold to historic levels based on really deep fiscal anxiety.
Yeah, if you connect it all up, the big message is the U.S. dollar strength. It's purely relative right now. It's reflecting deeper economic weakness and central bank caution outside the U.S. And gold breaking $4,000. That's not some victory for inflation bulls. It's really a flashing red light about profound anxiety over long-term government finances and, frankly, the decay of political stability worldwide.
Which leaves us with a pretty big question for you, the listener, to think about after we finish. Given this hardening strategic talk, especially Russia ditching the plutonium agreement, how will markets ultimately price the long-term risk to global energy supply routes, particularly if that strategic instability keeps bleeding into already tense regional conflicts?
That's the key question. The market's priced in tight supply already. The next level of risk is pricing in the potential breakdown of the established rules of the road, the strategic framework. And that could define energy prices for a long time to come.
A really critical deep dive today into some powerful forces reshaping the global landscape. Thank you for going on this deep dive with us.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.